Hello, welcome all. This side Abhilash. So in this session, I'm going to talk on the unit 3. So in the unit 3, we have to cover asset-based financial services, housing finance, insurance sector, then VCF, venture capital financing, banking product services, and mutual fund. We have discussed banking products and its services in the money and bank subject, so we don't need to recover again. So if you want to have a recap, you can just go through the link and you can watch the video on the YouTube. Okay, so let me start with the session. So factoring. This is another type of the financial services which is available in India. So let's discuss what is the meaning of the factoring. The word factoring has its origin from Latin word factor, which means door. The Webster Dictionary defines a factor as a one that lends money to producers and the dealers on the security of account receivables. Factoring is a financial transaction whereby a business sells its account receivables to third party, called a factor, at a discount in exchange of immediate money with which to finance continued business. Parties in factoring. There are three parties, main parties in factoring. The first is the factor, the second one is the client, that is seller, and third one is the customer, that is the buyer. The features of factoring. The factoring is a contractual service arising out of the agreement between the business firm and the factors. Factoring makes an advance payment generally arising from 80% to 90% against the invoices factured by the client firm and smoothness your cash. The factors finance the clients by purchasing all accounts receivable. The factor responsible for maintaining the sales ledger of client, so the factors takes care of all the sale transaction of the clients. So these are the advantages of the factoring. The client credit sales are immediately converted into cash as the factor makes a payment of around 80% of the factor invoices in advance. The cash realized from credit sales can be used to accelerate the production cycle. The client can expand his business by exploring new market. Some steps are involved in the process of factoring. So let me discuss that process. So let me show you the process first. From there you will understand. Okay, just give me a minute. So this is the mechanism of the factoring, the process of factoring. So you can see the customer, merchant, factor, right? So a merchant is nothing but a seller. The factor is a factor, and the customer is the seller. Okay, so the seller sells the goods to the buyer and raises the invoices on the customer. The seller then submits the invoices to the factor of funding here, and the factors verifies the invoices. Factor once verifies the invoices. After verification, the factors pays 70 to 80% percent to the clients, to the clients or seller. The factor then waits for the customer to make the payment here, credit transaction. Once receiving the payment from the customer, the factor pays the remaining amount to the client. Again here, customer means client. Fees charged by factor or interest charged by a factor may be upfront, that is in advance, or it may be in arrears. It depends upon the type of factoring agreement. In case of non-resource factoring services, factor bears the risk of bad debt. So in that case, factoring commission rate will be commercial comparatively higher. The rate of factoring commission factor reserve, and the rate of interest, all of them is negotiable. One can negotiate, and these are decided depending upon the financial situation of the client. So next is venture capital financing. So what you get in mind when you heard this word, venture capital financing. So when the startups boom started in India, that time we have heard this word, venture capital financing, all the startups all over the world, in India as well, right? So the venture capital financing is a type of funding by venture capital. It is private equity capital that can be provided at various stages or funding rounds. Common funding rounds include early stage seed funding is highly potential growth companies, startup companies, and growth funding, also referred to as Series A. The funding is provided in the interest of generating a return on investment or rate of interest through an eventual exit through the share sale to an investment body, another trading company, or to the general public via an initial public offer, that is IPO. So venture capital can be made in four methods. One is equity financing, second conditional loan, third income note, and fourth is participating debenture. The term venture capital comprises of two words, namely venture and capital. The term venture literally means a course of proceeding, the outcome of which is uncertain, but which is attended by the risks of danger of loss. On the other hand, the term capital refers to the resources to start the enterprises. According to narrow sense, the capital which is available for financing the new business ventures is called a venture capital. It involves leading finance to the growing companies. Features of venture capital financing. Venture capital financing is generally made in new enterprises that use new technology to produce new products. Venture capitalists continuously involve themselves with the client's investment either by providing loans or managerial sales or any other support. Venture capitalists usually finance small and medium-sized firms during the early stages of their development. These are the features of the venture capital financing. Advantages. The venture capitalist is a business partner sharing both the risks and rewards. Venture capitalists are rewarded by business success and the capital gain. It could encourage new breed of entrepreneurs to take up risk. They could also be part of economic growth. They can provide large sum of equity finance, bring a wealth of expertise to business which provides a solid capital base for future growth. Housing finance. Housing finance connotes finance or loans for meeting the various needs related to housing, namely. So housing finance means the banks are offering the loans for purchasing of a flat or a house, acquisition of a plot. Banks are offering loans for construction of a house, construction of a plot as well, extension of a house. If someone want to build a second floor on their ground floor, on the first floor, they can opt for a loan. Bank will provide you loan to construct a extension of a house. Renovation, repairs or upgradation of a house or flat. The loans are the housing finance are offering loans for repairs as well, renovation as well. Then if you want to do some furniture in your flat as well, you will get the loan. Need for housing finance. Social stability. Housing finance contributes to social stability by enabling households to purchase an asset which represent their large single investment. Housing represents 40 to 15 to 40% of the monthly expenditure to household worldwide. Economic development, by supporting housing finance, it promotes a successful economic sector and frees personal savings which entrepreneurs can invest in small business. So major institutions and banks involved in housing finance: HUDCO, SIDCO, then LIC, Housing Finance Limited, and DHFL. These are the institutions in NBFCs which are offering the loans, which are offering. These are the institutions which is involved in the housing finance. So basically nowadays HUDCO and SIDCO are not offering loan. Basically, uh, in the past, what happened if HUDCO or SIDCO launched any plan in area in city, they were offering installments. Okay, so that time they were involved. Nowadays they're offering a space, flats or house, but for the loan you have to go with the bank. So in the banks we have SCB, some commercial banks, RRB, SDFC. Then we have Axis, ICICI, SBI, Union Bank, then IDB. There are many banks which are offering the housing finance nowadays. Advantages of housing finance: employment for large masses. Rural housing develops not only rural areas but the prevent migrations of labor to urban areas. The creation of more houses resulted in building up a more infrastructure facilities such as roads, electricity generation, drinking water facilities. Factories and industrial establishment creates a townships by providing more housing facilities to their employees. So till now we have discussed the housing finance, venture capital financing, and the factory. In the next session we will discuss the banking products, mutual funds, and insurance products. Thank you. Best wishes.